Welcome back, dividend and value investors. Hey, today I want to talk a little bit about the real estate investment trust sector because it's getting hammered. People are talking a lot about it on social media. So in this video, I will give you two examples of why I think there's a lot of value right now in this market by looking into Realty Income and the Carey Realty Corporation. So guys, let's get started. So look, if you take the Vanguard Real Estate Index Fund ETF, it's trading currently at $77 and change. And it hasn't really traded here since the last 5 years, unless you take the COVID dip into consideration. So no wonder that people are really worried about it. Also, of course, the treasuries are up to 4%. So that's an alternative now for many people that are seeking income, and bonds might be safer in their perspective. And there's of course a lot of debt being accumulated in the real estate investment trust sector as well over the years, but not every stock is the same. For instance, if we look at Medical Properties Trust, they just gave an update on the 21st of August that they are slashing their dividend in half effectively and resetting the dividend because it became just too much for them. Debt-loaded company, the hospitals that they are serving don't seem to be so well capitalized, and that's hitting them. And you can see that, the pain is really hard then. While the stock was still trading $13 like back in the start of this year, it's now trading $5.34. The dividend cut was announced around, $10? So it went in half since then. Even if you are of the argument, okay, it was yielding 15% at the time, so if they cut it in half, it will be still 7.5%. Well, I still think it didn't really play out well for you, up till now at least, if you look at it from a share price point of view, because the price just keeps on tanking. Now, the question is, of course, can it go any further? Well, technically it can go to zero. For some people, this might be a value play. For me personally, this one is too hot to touch because it's not a high quality company for me. Hence, I also don't need it as a turnaround play. I've got already Intel in my portfolio as a turnaround play, and I want to keep it like that. Then also we got another dividend cut announced, and this one is from W.P. Carey, 25 years of dividend growth history. Well, of course, not every dividend cut is the same because honestly, I don't mind this one so much. Disclosure though, I don't own W.P. Carey, but what I like at least about management here is that they are proactive. We did with our newsletter that we introduced not too long ago together with my colleague from Dividend Talk, Derek. We mentioned already that the dividend's probably not growing above the rate of inflation because the company has almost no wiggle room. We expected a dividend cut maybe in several years from now if the trend continued as what it was doing. Well, management is not waiting because W.P. Carey decided to spin off the majority of their office portfolio. I'm not surprised for a few reasons. First of all, it's a really hard market to be in. Many people are working from home. Companies, corporates struggle with getting people to the office. Many people just want to work from home, specifically when they're all days in meetings and in calls. So I get that. And if you then want to, for instance, remortgage it once the debt expires, I can also imagine that the banks are requiring really a higher interest rate on this one because there's just more risk associated with that portfolio. Also, if you look at their debt schedule, they had until 2026 approximately, if you look at these numbers, they have about 55% of their debt expiring that all needs to be reissued and probably against higher rates than today. So yeah, to create more wiggle room in your earnings and having a lower payout ratio really makes sense for me. And that's why they are resetting the dividend policy to about a target pro forma adjusted funds from operations payout ratio of approximately 70 to 75%. I did a bit of a back on the napkin exercise, and I believe that the dividend cut will therefore be around 25% to 15% approximately. I think it's actually a wise move by management, and yeah, I give them credits for being proactive. But the question then is, of course, will you keep it? I believe you can keep it if you believe in the long-term business and if you're really satisfied with just generally how management is doing. I can fully understand it. On the other end, you can also start looking at opportunity costs. Maybe this is a good time to also make on your end your decision to do something different. Now, that's why I want to show you that there's still like really two good real estate investment trusts here that just seem to be tanking with the rest of the market, because we also need to remember when selling is happening in a certain market, it's not often only that they are selling single stocks. It's now happening across the whole entire real estate investment trust sector. And this is usually the reason because we are living in a time where many index funds exist. Many people buy index funds and sell them as well. So it might be just about throwing the baby out with the bathwater. So as an example, if we look at 2 monthly dividend income stocks, right? We have Realty Income here. Look, their assets really consist out of convenience stores, grocery stores, dollar stores, home improvement. Those are stocks that generally do well also during recessions, right? Also, if you look at their top clients here, Dollar General, Walgreens, well, I would say Walgreens is not the strongest one at the moment. Dollar General has also been a bit struggling with share price, but I don't see them going bankrupt or having any issues anytime soon with paying their rents. Yeah, 7-Eleven, there are really, really good companies in here. And also, these are just really small percentages of the entire portfolio. So really, really well diversified. Now, then, of course, what it really comes down to is like, what is their balance sheet then? Well, in an earlier video, I showed already that Realty Income has an A-graded balance sheet. One of the only 8 real estate investment trusts with such a strong balance sheet. The company is, of course, really proud on this. And, they put it here in a nice picture. But, I'm an investor that really wants to look at the 10Ks as well. So it's nice that they say it here. But let's have a look at the last quarterly report. And what we can see here is that the total mortgages that they have outstanding is about 16.5 billion. On a total stockholders equity of 31 billion. So debt to equity is relatively good. If we take the total debt, we're talking about 65-66% debt of equity. But let's look also then at their maturity schedule. What we can see here, so if we look until here, let's say 2027, we're talking about 15 to 20% that is maturing. This is way less than the 55% we saw at Medical Properties Trust. Yeah, the interest rates are already sometimes on the high end, 4.8%, 4.6%, 5%. I believe they will be probably reissuing around 5 to 6% and then really out in the future. What this means for me is like if they reservice it, let's say till 2040, if interest rates would come down in the next 5 years, they can probably pay it down faster and reissue it with cheaper debt. That's how you also typically do it with your own house, right? If you have a 6% interest rate on your house and later it will drop to 2% at the bank, you go to the bank and say, hey, can I pay this off? Yes, I pay a small fine and I'll take this loan for 2%. This is also how you can deal with this as a company like Realty Income. So I am not lying awake from this. Now, this is just one example of a company, and I will show later a little bit still of some of the metrics that I look at. But if we then go to Agree Realty, I consider this the younger brother of Realty Income. Probably Agree Realty is around 5-6 times smaller than Realty Income. So they have still much more room to grow, because one of the risks that I see with Realty Income is that they are so big to grow that they can only do major acquisitions. That's why they are diversifying into Europe. They bought the Bellagio in Las Vegas, starting to be a competitor to Vici, because they are in a need to do really big deals. This is not yet really the case for Agree Realty. Here also you can see grocery stores are only up to 10% of their entire portfolio. Home improvement, tire and auto service, dollar stores, convenience stores. I mean, again, all kinds of recession-proof businesses. If you look at the top tenant, it's Walmart, 6.5%. I believe that this is a top-notch company. Who doesn't want to have them as a tenant? We have got Tractor Supplier, Dollar General again, CVS. So actually they even have overlap with Realty Income's portfolio. But these are high-quality companies most of the time that I have no doubt about that they will be able to pay their the rent to Agree Realty. Now, what does the company say? Then the company also says like, hey guys, look, up till 2027, we have nothing to pay almost. Yeah, just 100 million. After that, it starts to play a role for us. So during this time of stress now, they have almost nothing to do. But this is also true. So let's also look at their 10Q here from the latest quarter. So what we can see here is that in total, they have 1.7 billion here in senior unsecured notes. And in total, they have 2.2 billion in liabilities that need to be serviced. Now, if we look at that then, here again, you can see it. After 2027, 1.75 billion will need to be paid back. So I'm really not worried about this. They didn't mention here the 3 million here, but okay, I'll forgive them on that one. They painted the grass a little bit greener, but that's also why we go to the 10Q. Nevertheless, it's still relatively small. So from my point of view, you've seen here 2 monthly dividend income real estate investment trust, Realty Income and Agree Realty. Really well managed, both in my opinion. Strong balance sheet. They have a bit their risks, but if you look at what's happening to the broader sector, I think these are just also being pulled down, and that's why I believe actually these are quite attractive valued right now. In a former video, I valued Realty Income at about $55. It's currently trading in the low 50s, around 51, 52. So that's why I'm saying already, for me, that company is undervalued. The same I feel about Agree Realty, because if we look at it, price to FFO for Realty Income is 12.5. I believe that these companies should trade at around 18 due to their quality under normal circumstances. Also, Agree Realty here, 14.4. If we look at the yield, almost 6% yield for Realty Income. This is unheard of. We haven't seen this for many years. Agree Realty also 5.12%. So a little bit lower yield, but I also believe it has to do with other factors. So both have around 74% payout ratio. They can still grow their dividend during these times, even if they have a little bit more, let's say, interest rate pressure. They should still be able to grow their dividend. However, what we will see is that Realty Income has been growing the dividend only, let's say only between brackets, with 3.8% over the last 5 years. And this is where Agree Realty shines. They are just able to grow quicker. I say that this is because of their smaller size compared to Realty Income, but with 6.7%. That's why for me, Agree Realty is really the most attractive of the two, because if they can continue doing this with their growth, we're talking here about a chowder rule that's about 12. Yeah, and this is not something you see often for a real estate investment trust. Their dividend history, however, is different. They had to cut the dividend like in 2010, 2011. But since then, they have been really reshaping their portfolio, investing into investment grade clients, and it pays off. And we see that here. So, the history is not the guarantee for the future. We can clearly see that also between the two companies. I believe that Agree Realty has just much more room to grow, and they have a better debt to equity ratio as well. So even they can do much more still with increasing their debt to grow their company. So guys, I believe they are both very much attractively valued. I also believe that the general sell-off that's happening currently in this sector is a bit overdone. Yes, there are quite some bad actors in there. I don't mind that there's a lot of index selling happening and that Realty Income and Agree Realty are also being pulled down with that, because for me, this is probably the opportunity of the year that we are having now. In the beginning of the year, it was the insurance sector. Now I'm looking at this sector, and definitely count on me to further increase my position in Agree Realty Corporation. And why? I've got already a ton of Realty Income, so I will move a little bit more of my upcoming money to Agree Realty. Hey guys, if you like this video, hit the like button. If you are not a subscriber yet, please subscribe as well, and I promise you more of these kinds of videos. Have a good weekend, guys.